In 2021, while you paid potentially 30% in taxes, Jeff Bezos paid 0.98%. Elon Musk, 3.27%. Warren Buffett, 0.1%. This isn't a conspiracy theory, this isn't tax evasion, this is the system working exactly as it was designed. While you're handing over 30% of your paycheck every single month, the super rich are living off of billions and barely paying anything. And the question you're all going to be asking is how? 3 words: buy, borrow, and die. It's the most powerful tax avoidance strategy ever created, and it's completely legal. It's how billionaires live in mansions, fly private jets, and have multiple homes around the world without paying any capital gains tax. It's how generational wealth is transferred, protected for decades to come. Today, I'm pulling back the curtain. I'm going to be sharing with you how the ultra wealthy protect their capital and their investments. And more importantly, I'm going to show you how by understanding this strategy is the first step for building wealth yourself. After all, this is the game. Let's learn how to play it together. Step 1, buy assets that are going to appreciate. This can be anything: a property, art, a stock, anything that is going to appreciate over time. And here's the critical part: you never ever sell them. And this is the foundation of the entire strategy. In the United States and most developed countries, you do not pay tax on assets until you realize the gain. That appreciation on your asset is classed as unrealized gain. And unrealized gains are not taxable for now. Let me give you a real example. Larry Ellison, the billionaire founder of Oracle. He owns billions of dollars in company stock, and it is appreciated very handsomely for him over the decade. If he sold it, he owes capital gains on every share he sells. If he sold his shares, he would owe tax on every dollar that has been realized. At the federal level, that is 20% in California, where he lived for years. Add another 13.3% state tax, and that is over 33.3% in total tax paid. So what does he do? He doesn't sell, he holds forever. His wealth grows, compounding year after year untaxed. He's sitting on billions in assets, but hasn't realized a dime. No sale, no taxable event, no tax. This is the first pillar of the strategy. It's about owning assets that appreciate over time. Wealth isn't about earning income. Income is taxed immediately and brutal. Assets held over time aren't taxed at all until you realize that gain. But here's the problem. If you never sell, how do you actually live? How do they pay for their mansions, their jets, and their crazy lifestyle? This is where step 2 comes in. Step 2 is where the magic happens. So instead of selling those shares and paying taxes on that lovely appreciating share that you own, what do you do instead? You borrow against them. You can use your stocks, your real estate, your business to take loans against them. And here's the beautiful part: borrowed money is not seen as income. And overall, most governments around the world won't tax loans. You can borrow 10 million, 100 million, $1 billion, depending on the assets that you're leveraging, and you will pay 0 tax on that loan. This is how the ultra wealthy access liquidity without ever triggering a taxable event. They are ultimately living off of debt. And usually, because they're borrowing against billions of assets, banks are quite happy lending to these individuals at considerably low interest rates. Let's go back to Larry Ellison. In 2014, it was told that he had a credit line for over 10 billion against his stock. He used that borrowed money to fund his lifestyle. He even used this money to buy an entire Hawaiian island for $300 million. Did he sell any stock to buy that island? No. Did he pay any capital gains tax? No. He borrowed the money, bought the island, and at the same time his stock carried on soaring. And ultimately, the interest on his loan is tiny in comparison to the tax he would have realized if he sold his stocks. Let's run the maths. If Ellison sold $300 million worth of stock to buy that island, he would have paid roughly that 33% that we spoke about, which is $100 million. Instead, he borrowed that money, and let's just think about that, probably at the time at around 3 or 4%. That's potentially $9 to $12 million a year in interest costs. But his Oracle stock, is it appreciating by 3 to 4% per annum? Yes, it's been doing absolutely amazing and soaring. So ultimately, he's paying 9 to 12 million in interest rates instead of paying 100 million in taxes. Overall, pushing his wealth to continue to compound. This is the billionaire's cheat code. They're not rich because they have high income. They're rich because they own appreciating assets and know how to borrow against these assets without selling them. They seem to live in a world where money is free and paying taxes is optional. But it gets better. Step 3 is the most powerful. Die. Keep those assets until the day you die. And then what you do, you pass them on to your heirs. Now in the US, something staggering happens when you do this. It's called the stepped up basis. When you inherit an asset, the IRS doesn't care what the initial owner paid for it. They reset the cost basis to the valuation on the day of death. All of that appreciation, all of those decades of growth, of compounding, poof, they have gone. It's now reset to the new value. Let's say my grandfather bought $1 million worth of stock in 1980. By the time he dies in 2025, that stock is worth $50 million. If he had sold before he died, he would owe capital gains on $49 million. That's roughly $15 million in taxes. But he doesn't sell, he holds until death and until you inherit the asset. The IRS apparently turn around and say, your stock is now worth 50 million. That is your new cost basis. If you sell at 50 million, the next day you owe 0 in taxes. I still can't wrap my head around how that's possible. This is how some of the richest families in the US have transferred billions in wealth to the next generation. The strategy is called buy, borrow, and die for that very reason. You buy the assets, you borrow against them, and when you die, you pass your assets on to your heir. And they inherit them tax-free, ready to repeat the same cycle. This isn't a loophole in the traditional sense. This is the law apparently working exactly as written. It seems like tax is designed in the US to favor asset owners over wage earners. It rewards patience, leverage, and generational thinking. The system seems rigged, although it's not a secret, just not that many people know about it. So what does this mean for you unless you're sat on a $10 billion stock portfolio? You can't exactly phone up Goldman Sachs and ask to borrow $5 billion against that imaginary portfolio. However, you can apply the principles and the strategies to your everyday life. Your job is to transition from a wage earner to an asset owner as quick as you possibly can. Secondly, it's most important to buy assets that appreciate. Property, stocks, investing in high growth companies. Assets that grow in value over time that you're not going to sell. You're not going to be day trading. You're not going to be trading in and trading out. This is generational wealth building at its core. You're not going to try to time the market. You're going to let these assets compound in their value completely untaxed for as long as possible. The third lesson is to be able to use leverage strategically. No, you're not going to get a $10 billion funding line from Goldman Sachs, but you could get a mortgage to purchase a rental property. You can get a securities-backed line of credit against your stock portfolio, or in the UK they call it a Lombard loan. You can borrow against your assets to fund new investments and also fund your lifestyle. And your main goal is to trigger as small amount as possible in taxes. Don't take a loan to buy a car, aka a depreciating asset in most cases, but do consider leverage when you are buying an asset or a stock. And you then use that money to acquire more appreciating assets. And fourth, think generational. Handing over that money to your heirs isn't just for the ultra rich, it can apply to you too. If you're planning on building a stock portfolio or a real estate empire, just remember that you can pass this on to your heirs. They will then go on and inherit them and continue this cycle again and again. The game seems like it's rigged, but it's not rigged against you due to conspiracy. It's rigged because it was designed for people that understand how money and leverage work. You've been taught to work hard, earn your paycheck, and save what is left. That's the game designed for wage earners. It's a game that you can't win, and the wealthy know this, and that is why they play a completely different one. Now you know the rules, it's just a matter of understanding which game are you gonna play. If you've enjoyed this video, then in the description you can gain access to my free online course, which will teach you more about budgeting, ETFs, and other investment analysis. Make sure we hit that thumbs up, like, and subscribe, and I'll see you in the next video.